Let's just dive right into this explainer, shall we? We're going to take what usually looks like pure, unadulterated chaos on a trading chart and transform it into a highly organized, professional roadmap. Seriously, if you've ever stared at a financial chart and just felt completely overwhelmed by all those jagged lines and erratic movements, you are definitely not alone. But today, we're decoding that secret language. We're going to look at the market exactly the way the pros do. You know, so many retail traders lose money simply because the market feels like absolute noise to them. It's just up, down, all over the place. But as they say, if you watch price long enough, the market actually starts to feel a whole lot less random. Those massive, strong moves, they almost never start from nowhere. They're actually part of a highly logical cycle, accumulation, manipulation, and distribution that the big institutional players rely on literally every single day. So here's our blueprint for today's explainer. We are looking at the 3 market phases, the anatomy of a trend, sideways range markets, the break of structure or BOS, and finally we'll wrap up with the golden rule of candle closes. Let's get to it. All right, part 1, the 3 market phases. The absolute fundamental truth of any market, no matter what asset you're trading, is that it can really only do 3 things. Right? It can go up in an uptrend where prices just keep pushing higher and higher. It can go down in a downtrend where the price keeps dropping, or it can be range bound, just moving sideways and bouncing around within a specific zone. Fun fact for you, markets actually spend the majority of their time in that choppy sideways phase. But at any given moment, every single chart you look at is sitting in one of these 3 distinct states. Moving right along to section 2, the anatomy of a trend. Now think of an uptrend like a staircase where buyers are securing new floors and actively defending higher basements. It is strictly defined by higher highs and higher lows. That's your HH and HL. On the flip side, a downtrend is precisely lower highs and lower lows, LH and LL. In that scenario, sellers are in complete control, driving prices downwards step by step. And here's the kicker. If you don't clearly see these specific structural swing points, you don't have a true trend. It's really that simple. Just take a look at this USD JPY chart. You can see how the price rigidly respects the lower highs and lower lows, riding right down that descending channel. Literally, every single time the price attempts to rally and catch its breath, it just forms a lower high before inevitably tumbling back down to create a brand new lower low. It's a textbook, picture-perfect example of sellers maintaining total structural dominance. Which brings us to section 3, sideways. The range market. Remember how I said markets spend most of their time moving sideways? Well, in a range market, price consolidates and builds liquidity. This is essentially the calm preparation phase, the calm before the storm, where institutional players are getting ready to trap retail traders. The price is just ping-ponging between a defined support floor and a resistance ceiling without making any new highs or lows. It looks like total indecision, right? But actually, it's a highly critical zone where orders are accumulating and the next major trend is secretly being prepared. All right, section 4, break of structure, or BOS. So how do we know a trend is actually going to keep going? That brings us to the break of structure, the BOS. This is your ultimate confirmation that the buyers or sellers from the previous trend are still firmly in the driver's seat. If we're in an uptrend, a bullish BOS happens the moment price breaks above that previous higher high. And if we're in a downtrend, a bearish BOS triggers when the price drops below the previous lower low. It's literally the footprint of a continuing trend. Spotting a BOS requires a really systematic approach. First off, you identify your current trend and map out your external swing highs or lows. Second, and this is the hard part for a lot of folks, you have to patiently wait for the price to completely shatter those boundaries, break past the previous high in an uptrend or the low in a downtrend. Then, step 3, once that break is confirmed, you use that BOS to confidently anticipate the trend is going to continue. You're letting the market structure dictate your bias instead of just blindly guessing. And that leads perfectly into section 5, our golden rule, candle closes. Now listen up, because this is the trap that catches thousands of beginners. A break of structure is only confirmed by a solid candle body closing fully beyond that previous structure level. That's your true continuation signal. If a wick simply pokes above or below the line, but the body doesn't close there, that's not a break. That is just the market hunting your stop loss. It's a liquidity grab, guys, not a confirmed structural break. The close of the candle is literally everything. As we wrap up this explainer, I want you to ask yourself before you place your very next trade, are you reacting to the chaotic noise and those tricky wicks, or are you waiting for the close like a pro? Understanding these fundamental market phases, tracking those higher highs and lower lows, and patiently waiting for a true body-closed break of structure. That is how you align yourself with the smart money. But hey, once that structure breaks, how do you actually enter the trade? Well, keep this blueprint locked in your mind because we'll be tackling exact entry strategies in our next explainer. Thanks so much for hanging out and learning with me today.